Hello and welcome to CMC Markets Trading Outlook for the week of November the 10th, 2014. My name is Colin Szynski, Chief Market Strategist. The topic of this week's video is, are markets ready for a reversal? For the last 2.5 weeks, stock markets, particularly in the US, have been screaming higher, and many of them have approached their all-time highs or traded to all-time highs. We've also had another big rally in the US dollar lately, coming out of a period of consolidation. There are signs, however, that markets are starting to get a little bit tired, and that the choppiness we saw at the beginning of October may start to re-emerge again at the beginning of as we move deeper into November. The last 2 weeks have been dominated by a number of major news reports, a lot of which were very friendly to the US dollar. In particular, the renewed stimulus from the Bank of Japan in increasing their quantitative easing program, as well as a lot of really dovish talk about asset purchases out of the ECB, helped to really drive another rally in the US dollar. And that at the time had pushed down crude oil, had pushed down other currencies, had pushed down gold. We also had seen a positive economic numbers from the United States pushing US stocks up as well, and in particular, and also a rebound in European stocks as we started to see signs of that more stimulus. People responded favorably to that, both in Europe and in Japan. Now as we reach the move farther into November and we've passed the US non-farm payrolls report, we're entering into a period where news flow is starting to dry up, not just on the economic side, but also on the corporate side. We're past the peak of earnings season. The earnings from large caps also start to wind down this week. So we're into a little bit of a lull here, and we may be at the point where people are starting to take profits, and where we could see markets start to fall back because they are starting to look tired after the big moves we've had over the last few weeks. And where I wanted to highlight this and start was with a couple of readings from our client sentiment feature. Starting here with the US 500, we see that in fact we're split here between bulls and bears. In terms of the actual number of clients trading, we're seeing a slightly long, led by the top clients. However, in terms of position value or size, we're still seeing clients very short on the S&P. So what we're seeing is that at this point, we have 88% of all clients are short, 68% of top clients. But overall, what this is telling us is that the people that are long, while there's still a fair number of people long the S&P, a number of people have come in short the S&P in size, which suggests that the bears are starting to get more conviction here, and that while people have small long positions, they have larger short positions, is suggesting people are starting to think that the S&P may start to come back. Looking also at the euro dollar here, we're seeing today that we have top clients 99% short in terms of position value against the euro US dollar, all clients 92% short. This trade's starting to get pretty crowded when you have almost everybody piled in on one side, and when you get to that kind of an extreme, you do start to think and look for reasons why perhaps can this continue. Who's left? If everybody's short, who's left to sell it down? And if that's the case, well, maybe it's getting due for a rebound, whether it's on short covering or otherwise, or any kind of changes in sentiment. So that's quite significant and something to keep an eye on. We may see play out over the next couple of weeks. Some of these moves that we've seen have gotten pretty extended, and we may be getting ready for a reversal here. So I'll start by looking at a few charts. We'll begin with the S&P 500, and one thing I did want to highlight here is that the U.S. markets overall are starting to see a weakening in breadth in terms of the bullish side. And I've been calling it a case of bad breath for the bulls, because what we're seeing is that some of the smaller, narrower indices like the Dow have continued to move higher, and the Dow reached an all-time high last week. However, the S&P just barely made one. NASDAQ really didn't, and the Russell 2000, the broader index, is well short. And what this means is that the bullish money seems to be focused in a small number of large cap stocks. But meanwhile, the troops aren't really following the generals anymore, and that's often a bearish sign that this uptrend may be getting close to an end and potentially getting ready to reverse course here. Looking at the U.S. S&P S&P 500. Very strong rally over the last couple of weeks here, and since then we've seen, however, on Friday we're getting a doji candle. What does this mean? It means that perhaps the bulls may be starting to lose a bit of their enthusiasm, a little bit of their control of the agenda, and the bears are starting to come back in, and we're seeing that move into balance. Oftentimes dojis can appear near peaks and troughs. As I said, it shows that there's a shift of control perhaps starting. Keep an eye out into the early part of the week of the 10th. If we do see it start to come back off, we could get a fairly significant, it could be a sign of a correction for U.S. markets. Also noting here, we have a overbought RSI, suggesting that perhaps the rally, it's gone from oversold to overbought, suggests that this rally might be getting overextended and getting due for a correction. Also wanted to highlight here the U.S. Small Cap 2000, the Russell, which is also showing that while we saw the S&P trading up here at new highs, or pretty much touching its new highs, we're actually seeing in the broader index another lower high here. Resistance has come in at 1180, down from 1190 the previous time. Current support about 1160, and then closer to 1135, then 1100. But if we look here at the RSI, had a good run. It was near oversold, rallied up. Now it's near overbought. It's starting to level off. The upward momentum is leveling off again at a lower high. Suggests the bulls are starting to lose a bit of their strength here. We could be gearing up for a correction in the U.S. small cap as well. Just wanted to highlight a couple of the big currencies. I will start with the Euro US dollar, which had been hammered pretty soundly over the last few weeks, and there is a reason why there's so many people are short the U.S. dollar right now. And basically what that is that it's been in a pretty steady downtrend for the last 8 months. We recently saw it take out 125 to kick off a new down leg. It's traded down to about 123.70. It's starting to find support here. It's having an inside day. The softer than expected U.S. non-farm payrolls have taken some of the steam out from the U.S. dollar. It had been steamrolling over everything. We're seeing the euro bounce back, but its rebound so far has been pretty feeble compared to some other markets, which I'll show in a minute. And so while we may get a trading rebound in the euro dollar, it may not see it get too far. There's initial resistance in here around 124.40. Then this is here around the 125 level, the 126 level. It remains in a broader downtrend. We do, however, are seeing, while we've had lower lows in the pair, we are getting higher lows in the RSI. That's a positive divergence, which is encouraging. But with the ECB still in stimulus mode, it's hard to see how this is going to get too far, even though it does look due for a bit of a bounce. Two of the markets that have shown a real response to Friday's North American employment reports are gold and the Canadian dollar. I'm going to start here with the Canadian dollar, which was really one of the big winners on Friday's trading. We had seen here. Now, in this case, this chart follows the U.S. dollar up and down. So when it goes up, the U.S. dollar is going up. So this decline here on the Friday, we have a bearish engulfing candle. We've had a rollover in the RSI, suggesting a turn in momentum underway, and we've had resistance come in here in and around 114.50. It started to falter now. It's gone back under 114. Initial support here around 113, and then this is around 111.80. This bearish engulfing candle shows that we've seen a real shift from the bulls that had been driving it up. It's been rejected, and the bears now have taken control of this market. Why? Canadian employment came out. It was a lot better than expected. People had been expecting a retrenchment from a big number the previous month. Instead, we saw follow through. And what's significant about this is we've had a great year for employment in the United States. Employment in Canada has been very mixed. It's been choppy, up 1 month, down 1 month. This was the first time in a long time we've seen 2 solid months of Canadian job growth. And what does this say? It suggests that the strong growth we've seen in the United States is starting to spill over into Canada. That's attracted new interest to the loonie, which has started to, with U.S. dollars starting to roll over. The other big beneficiary we saw on Friday out of the the soft U.S. non-farm payrolls taking the edge off the U.S. dollar was in gold. Gold is having a spectacular day on Friday. Look at this. We had a big sell-off midweek. It's getting a doji candle here, showing that the bulls and bears were back. So here, full control of the bears drove it lower. Doji candle says the bulls and the bears were coming into balance, and today, bang, the bulls have taken charge again. You actually have a positive key reversal here because you actually have a dip down to a 52-week low for gold, and now you've had a turnaround and a big rally here for gold. This is a hugely bullish formation. On top of this, we had gold deeply oversold. Crossing 30 is a signal of an upswing underway. So on a number of indicators are telling us gold is really starting to turn around here. The pressure gold's been under heavy pressure because of the unrelenting rally of the US dollar. With the US dollar now apparently starting to level off, maybe even correct a little bit, gold has been roaring right back to life here. We have some initial resistance here around 1170. These two lows here are at about 1193, and then we have the round number at 1200 for initial resistance points on a rebound for gold. Just as we're seeing gold come roaring back to life, we're also seeing some renewed interest coming back into crude oil. I'll take a look here at West Texas, which is on Friday has gained another 1%. Again, recently we saw that through the summer and into the fall, crude oil under heavy selling pressure. Beginning of October, the selling pressure even intensified against crude, especially after it broke 90, drove it down to this is the $77 to $80 zone. We're starting to get some support in here. A lower low for the oil price. However, we had a higher low for the RSI, suggesting that the downward pressure was starting to run out of gas here, and now we're seeing oil start to pick up. We're basically still in a consolidation channel here between 77 and 80. If we initial resistance here about 79.50. If we do start to break 80, would signal the start of a more significant upturn for crude oil. Crude oil could also benefit commodities that are sensitive to currencies. So the Canadian dollar can start to benefit from if we did get a rally in crude oil, along with the Norwegian krona. There are a few events during the week that I do want to highlight. It's not completely dead for news, but it is a lot quieter. We start off the week with a focus on China. When we come in to start trading on Monday, we'll have the Chinese inflation numbers come out. During the week, we'll also get trade, loans, retail sales, industrial production. So it's a fairly significant and active week for China. So if we look here at the Hong Kong Hang Seng, we'll see that it could be active. It's been quite volatile lately. Its declines in September were due to the protests in Hong Kong. We had a double bottom here down around 22,575. We've had a nice rebound in the last little while into late October, but in early November we are getting a bit of a retrenchment here, consolidation at a higher level. In the case of the Chinese numbers, people are wondering, is China really slowing down? How much is it slowing down, or is it stabilizing? Is it starting to bounce back? Those are the questions people will be asking of China throughout the week. This can have significant implications for not just indices like the Hang Seng and the China A, but also the currencies of countries that export to China, particularly Australia and New Zealand. I'll take a quick peek here at the Australian dollar and the Kiwi dollar. We'll start with the Aussie, which is here. And what we can see with Australia was that it had been pounded again and recently broke down as part of that big US dollar rally. It had been trading from in an 86.40 to 88.40 channel. It broke down from that. That measures you down to about 84.40 support. However, it has been picking up some support around 85.50. We are getting a rally here on the US dollar starting to come back. So, but I think for the Aussie dollar to move, you'd need to see some kind of sign of some strength out of China. If we get positive numbers out of China, that's good for resource demand, good for resource currencies. If we see weaker than expected data out of China, it could drag on commodities a bit, as well as on the resource currencies here. The New Zealand dollar also has the potential to be active this week as well, and we have a number of economic reports coming out from New Zealand this week, including both the business and the service PMI, along with retail sales. and inflation. It is a busy week for data coming out from New Zealand, so so the Kiwi dollar could be active once again. We've had we're only a couple of weeks out from the last RBNZ meeting. They were still trying to talk down the dollar, but at this point in time, what it seems to me is that here we've moved into, it's a 77 to 80 channel. The bottom end of this has slipped down into slightly below 77 to here about 76.60. But if we look at the RSI, some of the pressure against it and the downward momentum is starting to ease. I think you're pretty good with it continuing to bounce around in this, say, 76.50 to 80 cent range. This one doji here, this failed breakout above 80, does suggest that perhaps above 80 cents you may attract the ire of the RBNZ again and perhaps some intervention in the Forex market. But otherwise it does look as though it seems to be trading comfortably in this range. Initial resistance here about 78 and then in and around about 78.80 or so. The last of the major currencies I wanted to talk about today is the pound. The pound also has the potential to be active this week, and the reason for that is that we do have, particularly on Wednesday, we get the UK employment report. We also get the Bank of England's inflation outlook report. Both of these are quite significant because the Bank of England is the other central bank that appears most likely to raise interest rates this in 2015, along with the Fed. So people are looking now, continuing to look for the Fed to start raising interest rates around the middle of 2015. Perhaps they're meeting at the end of June. With the UK, people have still been speculating back and forth. Could they go sooner? Could they go later? And the two sides playing out are the strength of the UK economy versus the what would happen if Europe really slows down. Could that drag on the United Kingdom economy as well and force the Bank of England to delay normalizing interest rates? What are we seeing here in the market? With the US dollar taking off, has dragged on the pound. It's dropped from a high of about 172 back in the summer, recently falling below 160, which is here, and it may be emerging as new resistance along with 159. We had this huge sell-off last week that broke the 159, but we're not getting a huge amount of follow-through. In fact, we're getting a doji here and perhaps a key reversal. It's a little early to say, but we did see the pound get smashed down to a new low here, about 157.90. It's come back. It's positive on the day, but you may want to see a little bit more penetration into this big bearish candle before starting to think that it's turning around. Its downtrend remains intact. Initial resistance about 159, then about 160, and then about 160, 150. But also keep an eye on this down here at the bottom. We do have a positive. Our RSI divergence, all these new lows in the pair are not getting confirmed by the RSI, so your downward momentum is slowing. You could be in a case where you start moving into a sideways trading range, say between 158 and 162 is a longer term possibility for the pound as well. But it could be really active on Wednesday, particularly around those two UK figures. So even though things are quieting down a little bit in terms of the really big fireworks on the economic and monetary side, there are a number of developments going on. We could still see some choppiness this week, the possibility of a correction in some of the markets that have become really overextended lately, whether it's markets that have become overbought and trading at highs having a downward correction, or markets that have been really crushed and getting oversold having an upward correction. So overall, it still looks like an active week for trading that could present a number of significant opportunities. I hope you all have a great week.